After swinging around $2,650 per ounce early this fall, gold has risen by another $100 on its relentless drive to new highs. This has been the pattern of the current rally. Gold rose from $1,810 per ounce to establish a new base at $1,900, then rose again to consolidate at around $2,000. Soon thereafter, prices leapt to $2,300, then $2,400, then $2,500, and now we're set at a new solid base of $2,600 per ounce. At each milestone, gold has consolidated support, preparing for the next move upward, setting new price records along the way. The yellow metal has already cracked $2,700 per ounce recently, and I think it will soon establish that milestone as a new base. Goldman Sachs sees gold at $3,150 per ounce in 2025. That's right, another $490 rise next year, on top of the $850 appreciation since October 2023. I have previously identified 6 forces that have formed a tag team to drive this rally: inflation fears, interest rate hopes, the strength of the dollar, central bank gold buying, retail demand in China, and geopolitical conflict. Why am I confident the gold rally has legs? Let's look at the 6 forces that have been driving this rally. 1. Concerns about rising world debt, now exceeding $315 trillion, and prospects for a global tariff war are renewing fears about inflation. Rising worries about inflation often bolster gold prices. 2. Fears about inflation and rising U.S. budget deficits are constraining hopes for lower interest rates. These hopes have been a force sustaining the rally over the last 14 months. 3. Higher U.S. interest rates tend to produce a stronger dollar, which makes gold more expensive for holders of other currencies. 4. November's reset in gold prices has drawn central banks back into the market. China, Turkey, and Poland made major purchases last month. The Czech Republic, Hungary, and Serbia also have been active buyers this fall. 5. With a market share of almost 40%, China boasts the world's largest retail gold market. Chinese buyers have been a major driver of prices during the rally, but they took a break when China's central bank paused its purchasing over the summer. Now that the People's Bank of China has returned to the market, we can expect Chinese retail buyers to do so too, especially since China may allow its currency to weaken. This would make gold all the more attractive to Chinese buyers, as the yellow metal is the only reliable store of value available to most Chinese. And finally, there's the matter of rising geopolitical conflict. While we were enjoying family and football over the Thanksgiving holiday and binging on Christmas shopping, the world took a dramatic turn. It was easy to miss. Regional conflicts in Europe, the Middle East, and East Asia went global. The most dramatic development was the sudden collapse of the Syrian regime and the rush to feed on the remains. A coalition of Syrian rebels, Israel, Turkey, and Kurds claimed their shares as Russia fled Syria and took deposed President Assad with them. This is a geopolitical disaster for Russia, Iran, and their Middle East clients. It is a huge windfall for the U.S. and our friends in the region: Israel, Turkey, the Kurds, and Saudi Arabia. But there's a dark lining on these silver clouds. The fall of the Assad regime further destabilizes a powder keg that has been ablaze for 14 months, with conflict now engulfing 7 nations in the region, as well as Russia, the U.S., and our European allies. In East Asia, China grows increasingly aggressive around Taiwan and in the South China Sea, while one of our closest allies, South Korea, fends off an auto coup attempt. In the meantime, the war in Ukraine has expanded beyond the proxy war between Russia and NATO to include Iran as a supplier of war material and North Korea as a supplier of soldiers and armaments. In exchange, Russia is thought to be providing support for North Korea's nuclear weapons program, a dangerous development if true. All the while, nations that form the central core of NATO, the US, Germany, and France, face significant domestic political uncertainty and instability. I call these six forces a tag team because they are rotating in and out of the ring, driving prices ever upward. Today, geopolitics, Chinese buyers, central banks, and inflation fears are in the ring. Falling interest rates and the dollar are outside the ring, but their time will come. I agree with Goldman Sachs that gold is headed to $3,150 or higher next year. Now's the time to buy while gold consolidates at the $2,600 base to set new highs, as it has time and again in 2024. It's not too late.